Good afternoon. Welcome back to the latest edition of the InvestTalk market analysis for the week ending November 22nd, 2024. I'm host of InvestTalk, Justin Klein, and this week I'm going to title the video Trump Trade Trends Start to Emerge. And that's what I'll get into here in a little bit, sector dynamics, etc. But I like to always start off with this, the 1 week performance. What's interesting here is look at the Mag 7. Tesla's the only one that was up. Meta, Microsoft, Google, NVIDIA. Let's try that again. NVIDIA, Apple, I guess, was up a little bit as well. But certainly some names back on their heels. Lilly, Amazon down, even Broadcom, Texas Instruments, Qualcomm were all down as well. But outside of that, you see a lot of green this week, and it was really broad-based. So I thought that was most interesting. You're definitely seeing the breadth of the market widen out, and that is overall a positive. The 10-year that is sticking around here. It's moved up since late September, and this is starting to consolidate for potentially another leg higher. And I think another leg higher would be problematic for the markets as a whole. So I want to touch on that, but let's talk about this right here, the economic data this week. It was a pretty light week overall, but you had the housing market index that did tick up a little bit. So home builders getting a little more confident, even though their starts tick down. So I do like to follow a little bit more about what they say, what they do versus what they say. But existing home sales did tick up in the month of October. It's a little bit stale, and mortgage rates have moved up, so I don't expect this to gain much traction to the upside and kind of stay in this low level. 4 million homes transacted month to month. On an annualized basis, that's not very much, right? Pre-pandemic, you were closer to 5, all the way up north of 6. So certainly, and the doldrums here, you zoom all the way out, right? Where it's one of the lowest levels really since the financial crisis. So we're staying at those low levels, and I don't think that'll change in the medium term. Continuous claims for unemployment that did tick up to a new 1-year high and the highest level in 3 years, roughly, right? Look, this is 1.96, we're at 1.91 now. So a lot of people on the unemployment doles, and I think that will likely continue for some time. And it shows you the labor market is on the brink of breaking. I do think that. That's why the Fed is cutting. They want to get to more neutral, because there's a point where if you if when the labor market breaks, it kind of builds on itself. Okay, and so I think the Fed is trying to avoid getting there. Now the consumer sentiment did tick up a little bit. Obviously, sentiments on the equity markets is high. Unemployment rate is still relatively low, but overall we're kind of balancing here. It's definitely, I think, on the precipice of potentially breaking. Doesn't mean it has to. If the Fed policy and fiscal policy with the new administration coming on, that could certainly kind of save us from the economy really weakening throughout next year. So a lot to be determined, a lot of uncertainty as we head into 2025. When it comes to sentiment, though, this is very interesting. This goes back to 1987. 51% of Americans think stock prices will move higher. They've been this bullish since 2017. This is 2000, right? They're about as bullish as they've ever been. So I thought that was very interesting. Now, what is the Fed going to do? Now, let me go back. Let me step back here. A lot of people look at this and think this is bearish. And what this is, I call this is dry tinder. So what it means is there's a lot of weak hands in the market. So if you start to see a downtrend, if you start to have liquidity ebb, I think that's where this could become a problem. As long as liquidity remains robust, as long as the economy remains solid, the bullishness can stay for some time. It's when the downturn starts, is saying, okay, everybody's in, right? And now the downturn's starting, and these aren't people that are going to sit here and wait out a cycle. They're not strong hands; they're weak hands. And so I do think you could see a 2022 type of downturn in the markets, right? 20% down in S&P, 33% down in the Nasdaq, something similar to that. But that might not be until 2026. May not be until 2027. So just I wanted to preface this and just kind of keep your eye on that and know that in the back of your mind so that when a downturn starts, it's not something that's likely to just be a minor, uh, a minor pullback. I know when I say downturn, I'm talking about liquidity condition downturn, but that's not where we are now. Now, speaking of liquidity conditions, the Fed is still in the easing cycle, right? There is about a 50% chance they will pause on December 18th. There's just what are we, about 4 weeks away from that. And if you go out to, let's actually go out to the end of next year, the market's still pricing in about 2 to 3 cuts. Okay, so talking about maybe one cut in the next 2 months. What's the odds of that in January? Yeah. So there's about a 50% chance, 60% chance there'll be at least one rate cut between now and January, and then you'll get a smattering of them throughout next year. And especially with the Fed, with Donald Trump, right? He's going to want lower rates. He's going to want to probably manufacture a weaker dollar, et cetera. And he's probably going to push on Jerome Powell to lower rates. And so there'll be certainly some political pressure there as well. Now let's pivot over to the charts here. Okay, let me pull up some. Here's the Nasdaq. Nasdaq certainly weakening just a bit. If you look at small caps, though, small caps are strong. Look at IWM to the SPY. This is starting to get a nice uptrend. Small caps and mid caps. Let's go mid caps to the SPY, right? So here's MDY. That also is getting traction to the upside. So this is where you want to be, really, the mid and small caps. And actually, before I get deeper into the charts, let's go here, right? Talked about the trends that are emerging. So these are the returns of these different indices. Russell 3000 is the main benchmark. That's one we use internally for equities. And this 20-day is really what you want to look at, is what areas are outperforming and underperforming based on the moves since before the election. And you can see here, small caps up 2.5% there. The Qs are outperforming the broader market, but I believe this is for Wednesday, so this might be a couple days old. So this is probably more neutral now. Growth has been outperforming, value has been underperforming, but I'll show you some charts over the past couple of days where that's changing. But high dividend paying stocks definitely taking on the chin. Same with low vol. This is why I hate these. Oh, it's a low vol. No, 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 no. These are valid. This is just a certain type of investment style. It's not low vol. Anything equity is not going to be low vol. I think it's a terrible way to look at particular slices of the market. But from a sector perspective, you can see here there's some interesting ones where oil services did very well right after the election, but then they've started to come back, and just the broad energy space, the oil exploration and production, which would be here, that's starting to outperform now since the election. And so I'm seeing the oil names, E&P names, doing better than the service names. Utilities are starting to bounce back after getting hit on the chin. But what isn't bouncing back are biotechs. Look at biotechs, just red across the board, not just post-election, but really since then, since the RFK announcement. Same with healthcare stocks, not doing very well. I think that will continue. Let's see what is doing well. Communication services doing well, kind of slowing lately, but this week you had a bounce back in metals and mining, right? The gold stocks, they sank and then they bounced back, and so now they're actually outperforming since the election. So I thought that was interesting as well. Financials, those continue to do well. Banks had done the best, but they're starting to come back in, right? The last 10 and 5 days, that's 2 weeks basically, they're starting to consolidate and pull back, whereas the broader financials are doing better. And I think that is what we're focusing. Banks are fine. I don't have anything against the banks, but I think a lot of the other non-bank financials are going to do much better. What else? Real estate, that's getting a little bit of snapback because rates have stopped rising, and so that could be an interesting place. But I think I'm more selective. I wouldn't just buy REITs in general. So these are the trends that are emerging. You want to be, I think, long E&P energy names. I think you want to be long I think metals and I think gold that will continue to do well. I think industrials will continue to do well. And what else? There was another one. Oh, financials, right? Like I said, non-bank financials, I think will continue to do well. Consumer discretionary. Oh yeah, I didn't highlight that. It's consumer discretionary starting to pull back this last week, but overall, I think this will be the consumer is in fairly good shape, good balance sheet. Talked about that. What that those are positive. What would be negative? I think still healthcare, biotech, and potentially utilities. If rates continue to go up, I think this could be a bounce that doesn't have a whole lot of legs. Obviously, there's some AI data center utilities that I think could continue to show some strength, but you have to be very selective there as well. So, yeah, let's leave that there because I think I hammered those points home enough. But let's go to the charts, right? Gold, talked about gold. Look at the strength here, right? Pullback and just such a strong bounce, and it needed that pullback. To be honest with you, it was overbought, and now I think when you have this pullback, it refreshes itself. Some weak hands kind of dumped it, and now we're back to almost the levels we were right before the election. Right here's the day after the election, and um, it's definitely above where it opens right after the election. So I think that will continue to be strong. The GDX is not fully recovered, but I think it will. I think there's still some more upside on that front. What else do I want to get to? Yeah, let's look at the S&P in general. What's interesting here is uh, this is roughly flat, right? Look at where we were after the election, right? So it's Wednesday after the election on the 6th. We closed the S&P. What was this number? Where are we? There we go. 59.29. Where we are today, 59.69. Not a whole lot of movement, really. A lot of choppiness, to be honest with you. So I think there's going to continue to be a lot of divergences in this market. And I want to show you this. Here's the growth to value trade, right? So going back to that list that was showing how value had underperformed, but look at the last couple of days. Remember, that was on Tuesday or Wednesday. I think those numbers that were compiled. We update them weekly, so we'll update them next week. But look at this reversal, and this chart pattern is a bearish pattern where you have this move down, rally, and lower. What this is the growth to value trade. So if it's going up, growth is outperforming. If it's going down, value is outperforming. And this is starting to roll. So I think value is going to find some traction here, especially if you think of the sectors that are typically value sectors, right? Here's the financials. Talked about those of strength. Industrials, those have been a little choppier, but look at the last couple of days. Nice move higher over there. And then just small caps, mid caps, they tend to be more on the value side of the market, especially small banks, things like that, that I think are going to continue to do well. What else? What other sectors? Here's transportation. Here's the IYT. That's continued to show strength. And then if you let's look at like XLK. Right. This is this is not great, right? It's not even able to reach new highs from July, right? Look at SMH, right? The semiconductors move down. This looks very similar to that, right? This looks ready to break down. It's hammering on this 200-day moving average. What is that telling you? It's telling you it wants to break it and probably stay below it for some time. I think the only thing that's been holding up is Nvidia, and Nvidia had earnings. It moved up. It closed near the low of the day on Thursday, and then it followed through to the downside on Friday. And so that is a bearish sign. It's the only thing really holding up the sector as a whole. Look at Broadcom. Broadcom looking fairly weak. Look at AMD. That one looking weak as well. So just across the board in the semiconductor space, then you look at like an ASML, right? This is looking bearish. Look at AMAT, Applied Materials. That was down on earnings. LRCX, Lam Research, weak. So the semiconductors lead the tech space, lead the growth side of the market, and so I think you're going to see more follow through to the downside. I think into next year, it could hold up in December. Probably yes, because a lot of people have a lot of gains in these names overall, and they don't want to take a lot of gains this year. Maybe wait till January. But I think in the new year, I think you're likely to see a stronger follow through to the downside in the growth names versus the value side of the market. What else do I want to get to? Here's consumer discretionary. All right, look how strong that is. I see no issue there. The biggest weakness in the value side are the consumer staples, but this had some nice move up of the past couple days as well. And I don't know how much traction this will have because look, here's the IEF. This is not getting a rally. Okay, so if this continues to remain weak, same with the TLT, if rates continue to want to move to the upside, this will pressure the utilities. Here's XLU. This reversed on Friday. It will pressure XLP. It will pressure IYR, right, the real estate side of the market, et cetera. So just be cognizant of that is that duration risk is still a risk out there, especially if you get a Trump administration that leans heavily on tariffs, creates inflation. In many ways, there's many ways that he could create inflation based on policies, and I think this is going to continue to evolve as we head into 2025 and the new administration. But liquidity remains relatively robust. You can't really be too mad about the credit spreads. Here is short-term junk, short-term treasuries that continues in an upside. So until this really breaks, there's really no reason to worry too much about a major drop in the market because liquidity, at least through mid-January, is probably going to remain positive. Could be all the way through Q1. A lot to monitor, and we'll keep you on top of this, but that's what we are focusing on, is where is liquidity going. So far it is okay in the short term, and that's frankly as much as you need to worry about over the next month or so. One thing that's on the horizon is the yen. We had the yen carry trade unwind in July. That has come back, but inflation is ticking up in Japan. And so if they start to raise rates again, that could strengthen the yen. It could precipitate another yen carry trade unwind, selling of the S&P like we saw here in July. That would probably be the main catalyst that I could see for a downturn. Modest downturn in the short term. So be cognizant of that as we head into December. I think that's about it. I won't probably talk to you until after Thanksgiving, so I hope everyone has a wonderful Thanksgiving. And a reminder, the contents of this video are for educational purposes only and should not be considered as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a wonderful weekend.